Good afternoon, everybody. Today is Friday, September 9th, 2011. This is Brian Shannon from Alpha Trends. Let's take a look at this market here. The S&P 500, well, today obviously was down 2.5%. For the week, though, it wasn't down as much as it seemed like. It was down 1.6%. We take a look here. It's interesting that the year-to-date just went negative again for the NASDAQ today, and for the week we're only down 0.19% in the NASDAQ. So I think it felt a lot worse, but it's really kind of felt like another long week, even though it was only 4 days, as we had that. The gap down on Tuesday morning. Wednesday was a real strong day. Yesterday we started slipping, and then today obviously we gapped down and closed right near those lows. The 30-minute time frame, let's take a look actually at a 65-minute. So on here we have a 30, 60, and 120 period moving average, and when the time frame is 65 minutes, as it is here, those approximately equal to 5, 10, and 20-day moving average. Anyways, we've been observing this market kind of being in this bearish flag pattern that we'll talk about in a moment, more on the daily and weekly time frame. But we did lose some important levels here this week that that we would have liked to have seen hold as support if this market had a chance of a greater recovery. But again, with a declining 50-day moving average, rallies are generally, you want to consider them guilty till proven innocent, and really treat it cautiously. Here's that trend line on this bear flag. A lot of people are talking about and recognize this bear flag. It makes me think that maybe a good scenario for next week would be kind of a panic sell-off that moves down not only through that trend line but through these previous little lows down near about 114, and then if we were to get a bounce for a day or two, then I think that maybe it would begin to set up a bigger sell-off, which on the weekly chart, when we take a look at the measured move, this would be point A right in here, and these aren't meant to be exact numbers, but let's just call it 135, down to point B, which is, we'll just call it 110. So this would be a 25-point move. Point A up here to point B, and I'm not able to draw it really well, but point B right down here. Well, we get that bounce that brought us up just below that declining 50-day moving average, up to about, let's just call it 123. So we had a 25-point sell-off, and what this would do, this would give us, we would take that 123, subtract 25 points, the height of this move, from that, and that would give us a price objective down near about 98. Well, if you take a look at it, that $100 level is a big level. We obviously had broken the uptrend line from 2009. And when we take a look at the Fibonacci, the retracements that is off those lows, the 100 area basically is about a 50% retracement. So again, what that means basically is from this low up to this high, a 38.2% retracement. We've seen support found there. The next level, based on Fibonacci, would be a 50% retracement, and that's also our measured move objective. And again, a big level of prior support in here as well. So it seems like a good price objective for the downside. So in other words, that would bring us down another 17, 18 points, and obviously that's a good percentage away from here, and that's going to do a lot of damage to individual stocks and obviously the market as well. But we are in a downtrend on the weekly time frame. We have all these moving averages declining. We have lower highs and lower lows, and it's going to take either a lot of time or more pain through price depreciation to make this thing be in a condition where it's able to turn around. And there's nothing economically, politically, geopolitically that would indicate we're anywhere near a place where a turn should occur. So we have to continue to be very cautious, keep our guard up. Here's that trend line again, looking at a 30-minute time frame now, and we pretty much touched upon it when you draw a little bit more exact on these shorter term time frames. So again, next week maybe we get a move down towards about that 114 114 and a quarter to 114 and a half. I think this will be an important level. If we can get down to there and then bounce maybe up towards the declining 5-day moving average, then I think we could really see things break loose, in particular down below about that 112 and a half level. So we still have to look at this market again as very, a lot of reason for caution. And when we look at the channel that it's been in, that's defined this bearish flag, what we have now in here as well is this lower high. So we had these higher highs. Now we have a lower high. If somehow the market gets above this level next week, well, then maybe we're going to save a bigger sell-off for some other time down the road. But it just seems more likely that we're going to exceed the lows in this market. The Nasdaq, like I said, wasn't hit as hard on a percentage basis this week, and it was only down, really a fraction here this week. Again, if you take a look at this table here, it was down 0.19%, and it got back up towards that 50-day moving average again. We are back below this 54 level, so 54 is kind of, we've been assigning more meaning to that level than I think the market has actually, or I've been assigning more meaning to that 54 level than the market has actually told us is appropriate, because we had the 50-day moving average act as resistance, and then we had this lower high again this week in here. We are still holding this trend line in the Nasdaq. So again, it's stronger. It's a steeper uptrend line than what we're seeing in the S&P. So maybe we get a move down towards 52 early next week. We bounce, make a lower high, and then we start to see things fall apart a little bit more. There's nothing, you can't make a bullish argument by looking at this weekly chart, that's for sure. We have this bigger prior level of support, which is holding as resistance, and you see it's holding as resistance on a closing basis as well. Don't be fooled by a green candle. A green candle only means that for the week we closed above where we had opened on Tuesday morning. Here's the volume weighted average price for the 4 days of trading for the Nasdaq. So the average buyer was losing money. In the S&P 500, we saw that volume weighted average price acted as resistance in here today. And I was mentioning on Twitter that something that happens in a bear market is a lot of times you see even on a bearish day, you see these rallies that are actually pretty big rallies, but they're destined to fail, and they can shake you out of your bearish position. And that's what I think makes a bearish environment more difficult to trade in. So the Nasdaq, again, it's hard to make a bullish case for this. In fact, it's kind of foolish to make a bullish case when you look at that weekly time frame, in particular because it keeps closing below this prior support level. The Russell 2000 was hit a little bit harder. We saw last week it backed off from that declining 50-day moving average and couldn't make it up to the prior support. This market seems like it should probably go down to test that 60 level at some point here in the coming weeks. We've still got this trend line holding in here as well, so maybe we drop down towards that 65 level and then bounce back up and go from there. The semiconductors were down. They've got this little downtrend line. We did see a lower low this week by 1 penny, and we saw a lower high. But these are acting a little bit more neutral in here than the rest of the market. But neutral when we have a primary downtrend generally represents just a pause before the trend continues, and clearly the trend on the weekly time frame and on the daily time frame is lower. The financials were down 40 cents today, down 3%, and they're getting back down at the low end of what this range has been. And again, these consolidations within a primary downtrend generally just represent a pause within that downtrend. They're not, you can't look at this and say it's a double bottom, it's a triple bottom, now it's a quadruple bottom. You can say it's trying to find some support near that $12 level, but when we have a declining 10 or a 50, 100, 150 and 200-day moving average like we have here, these rallies are going to generally fail, just like we see the intraday rallies on a 1-minute time frame below a declining volume weighted average price fail. So we've continued to have a very treacherous market here. incredibly volatile. There's opportunity this week in both directions, and what's really made it frustrating has more than anything has been the gaps that are occurring each day. And this morning the futures didn't look like they were going to gap, but they did sell off right before the open. And anyways, hopefully we can at least just get a more sane market, because the gaps make it very difficult to trade. If we could just get something where we see some levels set up and we can trade from, then it will be a little bit easier environment to make money in. There are opportunities if you're paying attention and you're good, but it's a difficult environment. So enjoy your weekend and rest up for next week. Thanks for tuning in.